Welcome to the latest edition of Fundamentals. This time around, I'm going to look at one actively managed member of our list of 72 favourite funds, namely Fidelity Asia. The £2.6 billion fund's mandate is to generate long-term capital growth for investors and, as its name rather suggests, it seeks to do so by investing in companies that are listed across Asia's stock markets, but not Japan. Fund manager Tira Changpong-sang is very experienced and he takes a pragmatic approach to investing. He has access to Fidelity's large and experienced pool of analysts, and having joined the company in 1994, he knows and uses them well. The manager invests for the long term and, if he believes an investment to be sound, is willing to hold positions through short-term setbacks. Although this may result in some short-term volatility, the long-term results have so far spoken for themselves. The portfolio currently has 93 holdings compared to the 634 companies which make up its benchmark index, which is the MSCI Asia ex-Japan index. The top picks represent just under 40% of the assets, so Tira Changpong-sang is not afraid to take a strong view. The biggest positions in the fund as I sit here are Chinese internet phenomenon Tencent, Taiwan Semiconductor, another Chinese online giant Alibaba, Korean tech leader Samsung Electronics, and financial services firm AIA. By market cap, around 3/4 of the assets are in mega caps, just over a fifth in large caps, and most of the rest in mid caps. Small cap exposure is pretty much negligible, as we can see here. By sector, tech, financial services and consumer cyclicals are the three biggest sector exposures at 28, 27 and 18% of the portfolio respectively. That's nearly 3/4 between them. Just 2% of the assets are in mining stocks and barely 4% in oil. As Asia isn't particularly blessed in either sector, there's not a lot of defensive stodge in here either, with healthcare at 3%, telecoms at 2%, and utilities barely 1%. By country, China is the number one exposure, followed by South Korea, India, and then Taiwan. The fund is eligible for SIP sizes and dealing accounts, and the minimum investment is just one share. The fund comes with a yield of around 1%, and here we're talking about the accumulation units, where the dividends are automatically reinvested for you. Fidelity Asia's ongoing charge figure is 0.97%, so you do have to pay for the expertise of the fund manager. And for those who set store by such things, the fund comes with a 4-star ranking from Morningstar. So, those are the mechanics. The question to address next is why could investors consider Fidelity Asia Fund for portfolio inclusion today? And I think there are 3 possible reasons. The first is that Asia has been an excellent performer in 2017 with a 33% capital gain from the MSCI Asia ex-Japan benchmark. The fund has also done well. The second is that while Asia has performed strongly this year, the region is not expensive relative to other markets or its history. This is partly because Asia, like most emerging markets, did badly between 2012 and 2015, as we can see here. This chart shows annual performance and it was pretty modest compared to the gains made, say, in the USA or other developed markets. On a price to book value basis, Asia now trades on just 1.5 times compared to a 10-year range of 1 to 2.7. On earnings, a forward multiple of around 13.5 times is cheaper than the UK and America, which both trade in the mid to high teens. The third possible reason is Asia has got stronger demographics and less debt than the West, which is a pretty powerful combination for the long term. The region therefore offers exposure to themes that can be a lot harder to access by developed markets, such as soaring mobile payments use and e-commerce boom, in addition to the well-known Apple supply chain story and the gathering tale that surrounds electric vehicles. Asia is home to a lot of component suppliers and intellectual property in that particular field. But this isn't to say Fidelity Asia will suit every investor, also for 3 reasons. First, income seekers will not be excited by a near 1% yield. Second, the India story is now well known and the Mumbai market's looking pretty pricey, for example. China's cheaper, but still comes with debt risks, and its leading internet stocks, Tencent, Alibaba and Baidu, do now look expensive on most conventional earnings metrics, despite the risks which come with doing business in the Middle Kingdom. If you can name one Chinese entrepreneur who has lasted as long as some of their Western counterparts, you're doing better than me. So investors need to keep a close eye on the regulatory environment in China in particular. Oh, and just look how the trio share prices have done this year. Third, emerging markets are just that, emerging markets. Things can and do go wrong, so they can be volatile and are best suited to risk-tolerant, patient investors. North Korea is just one potentially political element that's quite volatile, while corporate governance in Korea still needs work in places, and investors are also still wondering whether the military will let the planned elections go ahead in Thailand in 2018. investors must therefore do the research on Fidelity Asia Fund to make sure that it fits with their overall strategy, target returns, time horizon, and appetite for risk before they put any capital to work. Thank you for watching, and I look forward to seeing you next time.